Bitcoin is on the move again. After a period of relative calm, the cryptocurrency market is showing signs of life. Bitcoin, the flagship cryptocurrency, has recently staged an impressive recovery, surging past key resistance levels. This price action has reignited hopes of a new bull run, with analysts and investors closely watching for further upward momentum. The question on everyone's mind is whether this resurgence is sustainable or just another temporary spike. Bitcoin's recent price surge is significant for several reasons. It marks a break above key resistance levels that have held the price down for months. This breakout suggests a shift in market sentiment, with more buyers entering the market. The question now is whether this momentum can be sustained. A sustained rally could signal the start of a new bull market. However, it's important to remember that Bitcoin is known for its volatility. Several factors could be contributing to Bitcoin's resurgence. One factor is the increasing adoption of Bitcoin by institutional investors. Major financial institutions are now offering Bitcoin-related products and services, signaling growing mainstream acceptance. Another factor is the weakening US dollar. As the US dollar weakens, investors often look for alternative assets such as Bitcoin to hedge against inflation. Despite these positive signs, it's important to approach the market with caution. Bitcoin is still a relatively new asset class, and its price is driven by speculation and market sentiment. This volatility means that corrections are always possible, and investors should be prepared for potential downturns. Only time will tell if this resurgence marks the beginning of a new bull market, or if it's just another temporary spike in Bitcoin's volatile journey. The recent surge in Bitcoin's price has been accompanied by a significant increase in futures leverage. Futures leverage allows traders to control a larger position in Bitcoin with a smaller amount of capital. While this can amplify profits, it also magnifies losses. The rising leverage suggests that traders are becoming increasingly optimistic about Bitcoin's future prospects. Open interest, which measures the total number of outstanding futures contracts, has been steadily rising in recent weeks. This increase in open interest, coupled with the rising leverage, indicates that more capital is flowing into the Bitcoin futures market. While this influx of capital can drive prices higher, it also creates a more leveraged and potentially volatile market. The use of leverage in financial markets is a double-edged sword. On the one hand, it allows traders to amplify their returns, potentially generating significant profits. This potential for outsized gains attracts more speculative traders, further fueling the price rally. On the other hand, leverage also magnifies losses, and a sudden price drop can lead to forced liquidations, exacerbating the downturn. As Bitcoin's price continues to rise, it's essential to be mindful of the increasing leverage in the market. While leverage can contribute to upward momentum, it also increases the risk of a sharp correction. Traders should exercise caution and manage their risk carefully, especially in a market driven by speculation and sentiment. Institutional investors are increasingly entering the Bitcoin market, and their involvement is seen as a major catalyst for the recent price surge. One of the most significant developments in this regard is the influx of capital into Bitcoin exchange-traded funds, or ETFs. ETFs provide a regulated and accessible way for institutional investors to gain exposure to Bitcoin without directly holding the cryptocurrency. On April 22, 2025, Bitcoin ETFs recorded their strongest day of inflows since mid-January, with a staggering $936.43 million flowing into these funds. This surge in ETF inflows highlights the growing appetite for Bitcoin among institutional players. These investors are drawn to Bitcoin's potential as a store of value and a hedge against inflation, especially in light of the weakening US dollar. The increasing institutional adoption of Bitcoin through ETFs is a significant development for the cryptocurrency market. It brings more legitimacy and liquidity to the market, attracting further institutional participation. This positive feedback loop can contribute to a more stable and mature market, potentially reducing volatility in the long run. However, it's important to note that institutional investors are also driven by profit and risk management strategies. If Bitcoin's price becomes too volatile or if regulatory uncertainty increases, these investors may choose to reduce their exposure, potentially leading to a price correction. Therefore, while institutional involvement is generally seen as a positive sign, it's crucial to monitor their activity and sentiment closely. With Bitcoin's recent surge, the question on everyone's mind is whether the cryptocurrency can finally break through the elusive $100,000 mark. The recent market activity, driven by factors such as increasing leverage, institutional inflows, and positive sentiment, suggests that this target is within reach. However, several hurdles remain before Bitcoin can reach this milestone. The $95,000 resistance zone is a critical level to watch. This price point has acted as a significant barrier in the past, and breaking through it would signal a major psychological victory for Bitcoin bulls. A successful break above $95,000 could trigger a wave of short-stop liquidations, further propelling the price upward. Beyond the technical factors, several fundamental drivers support Bitcoin's potential to reach $100,000 and beyond. The weakening US dollar, coupled with rising inflation concerns, is driving investors towards alternative assets like Bitcoin. Additionally, increasing mainstream adoption and institutional interest are providing further tailwinds for the cryptocurrency. However, it's important to maintain a balanced perspective. Bitcoin is known for its volatility, and corrections are always possible. Regulatory uncertainty and the potential for market manipulation remain concerns. While the path to $100,000 is becoming increasingly plausible, investors should exercise caution, manage their risk carefully, and be prepared for potential bumps along the way.